Hi there, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop any comments. Now, let's go for the analysis.
$2.11 to $2.37. That's the box. As of what? Late January 2026, Austin Gold Corp, ticker AUST, has been just violently oscillating in that tight channel. We're sitting at an implied market cap of roughly $32.45 million. But if you ignore the flat line of the last 2 weeks and look specifically at January 12th, you see the pulse. A single-day jump of 10.98%. This isn't a dead asset. It's a heartbeat.
It's a pulse, I'll grant you that. But let's be careful about confusing a heartbeat with a muscle spasm. That 11% jump you're citing is classic gap-and-go price action on a stock with an incredibly low float. You have to contextualize this against the macro monster in the room. Spot gold is trading at $4,987 an ounce. We are $13 measly dollars away from the psychological barrier of $5,000. In that environment, a $32 million microcap moving 10% isn't necessarily a sign of strength. It's just beta. The real question is, with gold at historic highs, why is this stock still stuck in the $2 range? Why hasn't it repriced to 10?
And that is exactly the central question we are here to debate. Is this valuation compression a structural inefficiency, essentially a mispricing, that offers an asymmetrical call option for the 2026 drilling season? Or, as I suspect you'll argue, does the delay in activity and the lack of institutional volume signal a discount that is entirely justified?
I am arguing the latter. You have a deferral of the Stockade Mountain drilling, you have a market that is pricing in potential rather than defined bounces, and you have liquidity risks that make this uninvestable for anyone managing serious capital.
I see the risks, naturally, but I'm looking at the Higgs premium, the technical setup, and the macro tailwinds. I believe AUST is the ideal vehicle for this great gold reset.
And I'm looking at the risks of exploration failure, the illiquidity, and the fact that we are betting on a drill bit that hasn't even turned yet in this cycle.
We are living through the great gold reset. $5,000 gold changes the economics of every ounce in the ground, even the theoretical ones. In this specific climate, Austin Gold is a high beta vehicle that is being severely underestimated. My thesis rests heavily on what I call the Higgs premium. We aren't just betting on rocks, we're betting on Executive Chairman Dennis Higgs. For the listeners who don't follow the boardroom roster, this is the man who is a founding director of Pretium Resources. Pretium didn't just do well, they exited for $2.8 billion to Newcrest. He led Uriner's Energy to a sale to Energy Fuels. This is management alpha. The current valuation discount is temporary, largely caused by the strategic decision to defer the Stockade Mountain drilling from 2025 to 2026. This wasn't a delay due to incompetence, it was a delay for data precision. Furthermore, look at the insider alignment. Management holds approximately 43.2% of the shares. Higgs personally controls roughly 27.9%. They aren't diluting for salaries, they're incentivized for per-share value maximization. This is an asymmetric trade.
I appreciate the resume, truly. Pretium was a massive win, and in this industry, past success is often the best predictor of future funding. But I come at it from a different angle. Exploration companies are probability games, not investments, until a discovery is actually made. Right now, unlike its peers, AUST is priced entirely on blue sky potential rather than defined ounces in the ground. You mentioned that high insider ownership like it's purely a benefit. I see it as a double-edged sword. With 43% of the stock locked up by insiders, the public float, the shares actually available to trade, is tiny. If you try to enter a position larger than, say, $50,000, the slippage is going to be brutal. You are essentially trapped in the position until they provide liquidity. And frankly, if this story is so compelling, where is the smart money? Institutional ownership is a meager 2.67%. That tells me the big funds aren't buying the Higgs premium just yet. They're waiting for the core samples.
I'm not convinced by the institutional argument because the lack of institutional ownership is exactly where the opportunity lies for the retail investor or the smaller fund before the crowd arrives. Once the institutions arrive, the 10-bagger potential is gone. But let's zoom out before we zoom in. I want to start with the macro indicators, specifically what we're seeing on the prediction markets.
You want to talk about Polymarket?
I do, because in 2026, prediction markets have become leading indicators, vastly superior to lagging consensus forecasts.
If you look at the polymarket contract for the Federal Reserve's January 2026 decision, there is a 99% probability of a no change or hold decision. We're talking about $471 million in volume on that contract alone. The market is screaming stability.
I concede that a hold signal is generally bullish for gold because it means the Fed isn't trying to shock the system with hikes. It keeps real rates relatively suppressed, which is, oxygen for precious metals.
Exactly. It reduces the risk of a liquidity crunch. It supports the gold supercycle. When you have 99% certainty of rate stability combined with $5,000 gold, that is the perfect incubation chamber for junior miners. It de-risks the financing environment for a company like Austin Gold. If they need to raise capital for drilling, they can do it without fear of the window slamming shut overnight.
That's a compelling argument for the sector, certainly. But if you consider the divergence, if we're looking at polymarket, let's look at the whole picture. Traders are currently assigning a 59% probability to Bitcoin outperforming gold in 2026. If capital is looking for a debasement hedge, a way to protect purchasing power, the prediction markets are suggesting the hot money might flow into crypto, not into a microcap explorer in Nevada.
I disagree with the interpretation of that flow. We have to distinguish between speculative flows and sovereign flows. The silent buyers driving this gold price to 5,000, the central banks in the global south and east, they are not buying Bitcoin. They're accumulating bullion. That provides the floor. The debasement trade favors Austin Gold's long-term funding model because mining equities have tangible asset backing. The smart money hedging sovereign debt risk is going into the metal, which lifts the juniors. Crypto is a different speculative bucket.
Fair enough. The Central Bank of China isn't buying Dogecoin. But let's bring this back to the company itself. You can have the best macro tailwind in the world, but if the valuation relative to peers doesn't make sense, the stock won't work. We need to benchmark AUST against the competition to see if this inefficiency you claim actually exists.
Go ahead. Who are you looking at?
Look at Nevada King Gold NKG. They're sitting at a $75 million market cap. Then look at Western Exploration, WEX, they're hovering around $40 million. Why are they valued higher? Because Nevada King has the Atlanta mine. They have a defined resource they can point to the ground and say, we have X million ounces right here. Western Exploration has the Aura project, which is advanced. The market is paying for ounces that have already been found. Austin Gold is sitting at $32 million, and what do they have? They have targets, they have theories. The discount isn't an inefficiency. It's an accurate reflection of the exploration risk discount.
That's an interesting point, though. I would frame it differently. You're comparing apples to oranges regarding the business model. Look at Headwater Gold, HWG. They're at a $34 million market cap, very similar to AUST, but Headwater uses an earn-in model.
Meaning they bring in a major partner to pay for the drilling?
Correct. They let a major mining company pay for the exploration in exchange for giving up a majority percentage of the project. It de-risks the downside, but it caps the upside. Austin Gold, conversely, retains 100% equity in their projects. In a $5,000 gold environment, you want 100% of the upside. If Stockade Mountain hits, AUST keeps it all. That leverage is worth the premium over a diluted earn-in model. You're paying for the right to keep the whole pie.
But owning 100% of a failure is still zero. And without a partner, AUST bears 100% of the burn rate. They have to keep the lights on.
And owning 100% of a discovery is a potential 10-bagger. And, AUST isn't operating in a vacuum. You have to look at the business relations. They have deep ties to Nevada Exploration Inc. for data sharing on hydrogeochemistry. They have legacy ties to Energy Fuels UUU via the Uraners connection. This isn't a team strictly working in isolation. They have a network that facilitates M&A or deal flow. That network effect is an intangible asset the market is ignoring.
Networks are great, but drills make discoveries. And that brings us to the elephant in the room, the Stockade Mountain deferral. This is the sticking point for me.
I knew this was coming.
Of course it is. They pushed the drilling from 2025 to 2026. In the junior mining game, time kills internal rate of return, IRR. Investors were promised a catalyst in 2025, and they got a delay. Furthermore, Stockade Mountain is in Oregon. That is a significantly tougher permitting environment than Nevada. We've seen opposition risks there before. Why should investors trust that this delay isn't just the company kicking the can down the road because they ran into bureaucratic trouble?
Because it wasn't a delay for the sake of delay. It was disciplined capital allocation. They paused to run CSAMT surveys.
For the listeners who aren't geophysicists, let's clarify. Controlled source audio frequency magnetotellurics.
Correct. Think of it like an MRI for the Earth's crust. It measures resistivity. They use CSAMT to better target deep feeder zones, specifically in that 200 to 300 meter depth range. The historical IP-induced polarization data they had was insufficient. It didn't look deep enough. If they had drilled in 2025 based on that old data, they would have been drilling blind. They would have burned treasury on empty holes. By waiting for the CSAMT resistivity data, they can identify the silicophide zones, the resistors, that actually host the high-grade veins.
So you're saying the delay actually saved them money?
Absolutely. In exploration, the most expensive thing you can do is drill a hole in the wrong place. I would rather they wait 6 months and hit the target than drill early just to satisfy an arbitrary calendar. The data suggests they are hunting for a high-level epithermal system, and those feeders are tricky. You need that resolution.
I'm sorry, but I just don't buy that entirely. Delays often mask operational issues. We need more data is the oldest excuse in the book when a permit is stuck on a desk somewhere. However, I will grant you one thing. The permitting of the water well in Q4 2025 does suggest they're serious about logistics. You don't permit a water well if you aren't planning to turn a rig.
It absolutely does. And look at the spending. They dropped $250,000 on a marketing spend with I2I Marketing Group in late 2025.
$250,000 on marketing? For a company with no revenue?
Yes! Companies do not spend that kind of money on marketing if they're running on fumes or expect bad news. That is a bullish signal. They are preparing the market for a narrative shift. They're buying visibility because they believe they will have something to show.
Oris, they're pumping the stock to raise capital because they're low on cash. That's the cynical view, but it's a valid one. A marketing blitz often precedes a private placement. If they're about to dilute shareholders, they want the stock price as high as possible before they announce the financing.
Their burn rate is low. Kelly Creek lease payments are minimal. They have the treasury to support this. That marketing spend is offensive, not defensive. It aligns with the 2026 drilling campaign. They want eyes on the stock when the core comes out of the ground.
Let's pivot to the market structure itself. We talked about the float, but let's talk about the plumbing. I'm looking at the short interest and the dark pool data.
The short interest narrative is a myth. I've seen the retail boards claiming a short attack is keeping the price down. The short interest is negligible. We're talking about, 25,548 shares? That is 0.33% of the float. The market is not betting against Austin Gold.
On the lit exchanges, sure, but look at the dark pool activity. The off-exchange short volume ratio is sitting at 31.86%.
That's standard market making.
It is market making, but it masks the true depth. When you have 30% of the volume being internalized by wholesalers, it means we aren't seeing the true buying or selling pressure on the chart. It creates a false sense of liquidity. Retail investors see the bid and ask on their screen, but a third of the action is happening away from those displayed prices. It suggests that while there isn't a massive short attack, there is a lot of churning happening that isn't contributing to price discovery.
I interpret the technicals differently. I see a coiled spring. The stock is consolidating. It hasn't broken out yet because of that deferred news flow. You have a backlog of catalysts, the CSEMT results, the drill mobilization, that is going to release into a thin market. When that volume hits with 0.333% short interest, there is no resistance to the upside. There are no sellers left. Everyone who wanted out has had 2 years to sell.
I worry about the data quality, though. In 2025, they had to run a QA/QC review on the soil data at Lone Mountain because of unusual patterns.
That shows integrity. They caught it and fixed it.
It shows that exploration is messy.
Technical integrity is good, yes, but it highlights the risk of false positives. You can have high arsenic and antimony, the pathfinders, and still have no gold. Investors need to understand that the probability of success, even with CSAMT, even with Dennis Higgs, is statistically low. The geology can be cruel.
but the payoff is statistically massive. That's the nature of the beast. You don't buy a junior miner for a 10% dividend, you buy it for a 1,000% repricing. Okay, let's wrap this up. To summarize my position, AUST is a high-risk, illiquid play. It's suitable for position building if you have a very long time horizon, but it's not a trade. The lack of current resources and the complete reliance on a binary drill result in 2026 makes it highly speculative. You're buying a lottery ticket, albeit one printed on very nice paper with a famous signature on it.
And I'll conclude by saying that at a $32 million market cap with gold at $5,000, Austin Gold is an inexpensive call option. You are betting on a management team that has delivered billions in exits. The delay for CSAMT was smart. The marketing spend is a signal. I think the Higgs premium is real, and the market is about to wake up to it.
But the geology doesn't care about the signature. The 2026 Stockade Mountain drilling is the binary event. That is what will determine if this valuation compression is an opportunity or a trap.
On that, we can agree. It all comes down to the drill bit in 2026. That brings us to the end of this debate.
Until next time.
If you like this video and want to watch more content like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching. See ya.